Thanks for clicking! All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of October, with most economists thinking inflation likely slowed again. We got our answer at 8:30 this morning when news came in that inflation had slowed to 3.1%, down from the previous month's 3.8%.
Sale is made on every call you make.
However, the big news was that core inflation, the measurement the Bank of Canada uses when deciding its interest rate trajectory, came in slower than expected. Following the release, Robert Kavchak of the Bank of Montreal, well known for calling nonsense on the supply argument during the pandemic real estate bubble, took to Bloomberg to note that while the low CPI meeting cements a Bank of Canada rate hold at its next announcement, don't expect interest rate cuts anytime soon. So what I want to do today is go over Canada's inflation data for the month of October and the encouraging signs that we see stemming therefrom, look at Robert Kavchak's interview with Bloomberg, and then discuss what to look for next. Speaking of next, Bank of Canada Governor Tiff Macklem is expected to speak tomorrow, and will no doubt be addressing the encouraging CPI read that we got today. We'll obviously have an update out on that speech on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. As mentioned, Canada's inflation rate came in at 3.1% in October, driven in large part to declines in gas prices.
I've been saying it for 10 damn years.
Yep, about that. If we take out gas, the CPI rose by 3.6, down from the 3.7 in September, though prices for services rose at a faster pace. Food, the measure that Canadians actually care about, actually decelerated on a month-to-month basis, coming in 0.1% less than the previous month. Finally, mortgage interest costs, again, were the largest contributor to Canada's inflation rate, accounting for 30.5% of the increase in the CPI, followed by rent, food, taxes, and personal care. Cue the usual suspects arguing that the bank should cut rates as interest costs are doing the majority of the interest rate causing, forgetting, intentionally or not, that the Bank of Canada does not set fixed rates. Those are set by the bond market.
I don't know what that is.
And, according to the most recent data that we got in May, very few borrowers are taking variable rate mortgages. So, even if the bank were to cut rates down to zero, interest rates would still be high, but so too would the price of everything else.
Not at all what I intended.
Regardless, as mentioned, the big news is core inflation, which is showing some significant signs of slowing, with CPI median and CPI trim down 0.3 and 0.2% respectively. And the core numbers look even better when we take a look at the 3 and 6 month trends, with CPI median and CPI trim up 1.3 and 1.4 over the past 6 months, and up 0.29 and 0.34 over the past 3 months, or annualized at 1.2 and 1.4. If this holds, this is definitely a slowdown in Canada's core measures of inflation, exactly what the Bank of Canada wants to see. So, all in all, we have Canada's headline inflation data coming in at 3.1% as expected, but the big news is that Canada's core inflation data is coming down faster than many had anticipated. And Robert Kavchak of the Bank of Montreal went on Bloomberg to note that these measures, the measures of core inflation that we saw today, are going to be very good news for the Bank of Canada.
And on the inflation front, I mean, this is really the sticking point for the Bank of Canada, and I do suspect that there's some good news here with respect to how these core measures are evolving over the last 3 and 6 month periods.
However, says Kavchak, that doesn't necessarily mean that rate cuts are right around the corner.
The question is, I mean, how long do they have to sit here? And we would suspect that given we are still above target on these inflation numbers, that it's still pretty premature for the bank to start turning dovish and to start thinking about rate cuts in the next, let's say, 6 to 8 months. That would probably be a story for the second half of 2024.
So, while the Bank of Canada's Market Participant Survey, which has proved overly optimistic in the past, is predicting rate cuts as early as April, Kavchak is saying that those cuts may not come for 6 or 8 months, may not come until July in the summer of next year, bypassing the spring real estate market.
But you can't do this to me.
The yields on 5-year government bonds fell immediately following the CPI release, though shot up soon thereafter, though the bond market is still expecting rate cuts much sooner than it was a few weeks ago. With that said, I think it's worth noting that Bloomberg ran a report a few days ago, noting that the bond market has predicted rate cuts 7 times over the past 2 years, and has been wrong in at least 6 of them.
Those are rookie numbers in this racket.
So, all in all, good news coming out of Stats Canada this morning. I don't think we should read too much into the headline figure coming down, as that was driven by gas prices, which, as we all know, can change in an instant. But core measures of inflation, the measures of inflation which matter, are on their way down. Core measures of inflation are slowing. These measures all but cement a rate hold at the Bank of Canada's next announcement in December, though we're still a long way away from rate cuts, which I suspect we'll hear from the Bank of Canada governor tomorrow. We will obviously have an update out on the governor's speech tomorrow. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.